Something remarkable is happening in global finance. While most of the Western world has been fighting inflation with higher interest rates, China is doing the exact opposite. It's been methodically nudging down its lending costs, and this move is creating a powerful new undercurrent that most investors are missing. They believe this is just about propping up China's own struggling economy, but this misses a huge part of the story. The reality is, this is a strategic play that's starting to influence the price of everything from essential commodities like oil and metals to the flow of capital around the world. This is the story of how China is trying to build an alternative financial world, right under our noses. For decades, the global financial system has run on a single operating system, the US dollar. It's the currency most central banks hold, it's what oil is priced in, and it underpins the vast majority of global trade. If you want to do business on the international market, chances are you're doing it in dollars. This system has provided stability, but it also gives the United States immense economic and political leverage. The Federal Reserve's decisions in Washington, D.C. can send shockwaves across the entire globe. For years, there has been little alternative. The dollar has been the undisputed king. But what happens when the world's biggest manufacturer decides it wants to start pricing its goods and its loans in its own currency? So why is China making its money cheaper right now? The answer lies in two very different stories that are happening at the same time, one of weakness at home and one of ambition abroad. First, the domestic weakness. China's economy is facing serious headwinds. The most visible problem is its property market, which is in a prolonged downturn after years of explosive growth. This is a huge problem because real estate was the main engine of China's growth and the primary way that average Chinese families built wealth. This property slump has created a crisis of confidence. Consumers are reluctant to spend and businesses are hesitant to invest. And we can see this in the data. Despite the government pushing interest rates to multi-year lows, the rate of overall credit growth has slowed. It's a clear sign of weak domestic demand. So Beijing is in a tough spot. It's making these incremental cuts to interest rates not from a position of strength but to fight off stagnation. But that's only half the picture. While China is fighting a defensive battle at home, it's simultaneously launching an offensive on the global stage. These same low interest rates that are meant to stimulate its domestic economy are also making it cheaper for the rest of the world to borrow in Chinese yuan. And this is where the game starts to change. This policy of cheaper money is not just a domestic stimulus package, it's the engine for China's long-term strategy to build a parallel financial system, and we're already seeing the effects. First, there's a new source of capital emerging. For decades, if a developing country needed a big loan, they'd almost certainly get it in US dollars. Now, there's another option. China is encouraging foreign governments and companies to borrow directly in its currency by issuing what are known as panda bonds. And it's working. Issuance of these bonds has hit record highs in recent years, with a growing list of governments and companies starting to tap into this new pool of capital, diversifying away from the dollar. Second, this is having an impact on the price of key commodities. We know China is the world's largest consumer of raw materials, from iron ore to copper. Its appetite can literally move global prices. Research from institutions like the IMF shows a significant link between China's overall economic health, which is fueled in part by its credit conditions, and the demand for base metals and oil. This means the policy decisions made in Beijing are becoming an increasingly critical factor for anyone trying to predict the price of gas or the cost of construction materials. Third, this is a direct, albeit slow-moving challenge to the dollar. Let's be clear, the yuan is not going to replace the dollar overnight. The dollar's dominance is still overwhelming, but the foundation for a multi-currency world is being built. According to SWIFT data, the yuan's share in global payments has steadily climbed from under 2% a few years ago to around 4 to 5% today. This trend has been accelerated by geopolitics, as countries facing US sanctions have actively shifted some of their trade into yuan. To facilitate this, China has been developing its own financial plumbing. It created the Cross-Border Interbank Payment System, or CIPS. It's often called a SWIFT alternative, but that's not entirely accurate yet. CIPS is a settlement system for yuan transactions, and it still often uses SWIFT for messaging. But every trade settled and every bond issued in yuan strengthens the CIPS network, creating an infrastructure that runs parallel to the Western-dominated system. However, this grand strategy is built on shaky ground. The very domestic weakness that motivates China's low-rate policy also poses the biggest risk to its success. You can't project financial power abroad if your economy is crumbling at home. The biggest question is whether this is sustainable. While official reports claim that bad loans at Chinese banks are low, some analysts believe the real number could be much higher, hidden in complex local government debt. Pumping more cheap credit into the system could be kicking the can down the road. Furthermore, there's a fundamental contradiction in the data. Despite those multi-year low interest rates, loan demand remains weak. This suggests a deep-seated lack of confidence within China. It has the classic symptoms of what economists call a liquidity trap, where cheap money loses its power because businesses and households are simply too cautious to borrow. And while the yuan's use in trade is growing, its role as a global store of value remains tiny. The yuan's share of global central bank reserves has been relatively flat for years, hovering around just 2 to 3%. That's because, unlike the dollar, the yuan is not freely convertible. Beijing's capital controls mean that moving large amounts of money in and out of China is difficult. Until that changes, most central banks will be reluctant to hold large reserves in yuan. So, what does this all mean? China is not becoming the world's new cheapest lender overnight. But what is happening is a profound and strategic shift. It's a two-front strategy. At home, cheap money is a desperate attempt to revive a flagging economy. Abroad, that same cheap money is an invitation for the world to join a new financial ecosystem, one where the rules are written in Beijing, not Washington. This isn't just about interest rates, it's about power and influence. As China carves out its own financial sphere, the real question isn't whether the yuan will replace the dollar tomorrow, but how the world will operate with two competing financial systems. What happens when countries and companies have a real choice? That's the game that's changing right now. If you want to understand the forces reshaping our world, from finance to geopolitics, make sure to subscribe and hit the notification bell so you don't miss our next deep dive. Let us know in the comments. Do you think China's strategy will succeed, or will its domestic problems derail its global ambitions?